Welcome to Market Minute. I'm your name, and today we're diving deep into why the market is rallying on March 5th. Let's begin with the global cues influencing this trend.
Thanks for having me. Indeed, global markets are thrumming with optimism as inflation fears ease. Central banks hinting at rate cuts have sparked confidence, and this sentiment is making waves in the Indian markets, lifting the Sensex.
It's fascinating how interconnected these markets are. But what about potential pitfalls? Could unexpected geopolitical tensions undermine this rally?
Absolutely, geopolitical issues could shift the dynamics. For instance, recent tensions in Eastern Europe briefly spooked investors. However, central banks' dovish tones seem to overshadow such fears, at least for now.
Looking ahead, do you think this global optimism will sustain? Or are we bracing for a correction soon?
While short-term corrections are possible if central banks follow through on rate cuts, we could see sustained growth. However, vigilance is key as external shocks could change the trajectory quickly.
Turning to domestic factors, let's explore what's driving investor confidence in India. Strong corporate earnings and GDP forecasts are in the spotlight. Can you shed more light on this?
Certainly, recent quarterly reports have shown that several major corporations, particularly in banking and IT, are outperforming expectations. This robust performance is pivotal in boosting investor sentiment.
That's promising, but some argue these earnings might not fully reflect economic realities, especially with potential inflationary pressures. What's your take?
It's a valid concern. While inflation could impact future profitability, current indicators suggest a resilient growth trajectory. Moreover, proactive fiscal policies might mitigate inflation risks.
Looking forward, do you foresee these sectors continuing to lead the market rally?
Indeed, as long as technological advancements and banking reforms continue, these sectors are poised for sustained growth. However, investors should remain vigilant about policy shifts and global economic changes.
Let's delve into the psychological aspect, investor sentiment. How crucial is market psychology in sustaining rallies like these?
Investor sentiment is incredibly influential. When confidence is high, as seen with the current easing of inflation fears, it can propel markets further. However, sentiment can shift rapidly with new economic data or geopolitical news.
But isn't there a risk of irrational exuberance driving prices beyond fundamentals?
Definitely, that's a risk. Historical data like the dot-com bubble shows how sentiment can lead to overevaluation. Hence, investors must balance optimism with a critical evaluation of market fundamentals.
How should investors navigate this landscape moving forward?
Investors should stay informed and diversified. Keeping an eye on macroeconomic trends while balancing portfolios can help mitigate risks associated with sudden sentiment shifts.
As we wrap up, let's talk about the future. Is the current rally a sign of long-term growth, or should investors remain cautious?
While the rally reflects genuine economic strength, it's wise to remain cautiously optimistic. Factors like global economic shifts and domestic policy changes could affect the trajectory.
Some analysts suggest diversifying into emerging markets for better resilience. What's your view on this strategy?
Diversification is always a prudent strategy. Emerging markets with their growth potential offer attractive opportunities. However, they also come with higher volatility, so risk assessment is crucial.
So, in conclusion, what's the key takeaway for our listeners?
Stay informed and adaptable. Monitor economic indicators and remain flexible with investment strategies to navigate market changes effectively. This approach will help capitalize on opportunities while mitigating risks.